there were an award given for the instrument which, over the past generation, has seen the most explosive growth in terms of both scope and number, that award would undoubtedly go to ETFs, which over the past 20 years have become very much a dominant force within equities markets. This chart here looks at the growth of ETFs in the United States from 2003 through to the end of 2022. And you can see there is a remarkably consistent level of increase in these instruments. And the final figure of 2,702 is a little bit deceptive because that figure is now historical. According to the NYSE, the current data is that there are 3,030 ETFs listed in the US. They have a staggering 5.9 trillion in assets. The average daily value of US ETF transactions is a remarkable 149.373 billion. And the average daily volume of shares traded is 2.3 billion. In any context, these are really quite remarkable numbers for an instrument class that really didn't exist to any great degree 20 years ago. And when we look at the top 10 providers of, or issuers of ETFs in the US, you get a sense of the enormous depth of the market. But we need a little bit of context. All things require context to get a sense of how extreme this growth has been. As of March 2023, there were 2,385 actual listed stocks on the NYSE. There are more ETFs listed than there are stocks on the NYSE. And you might ask why this is. Well, it's quite simple. A single instrument or index might be covered by multiple ETFs. For example, the S&P 500 might have 24 competing ETFs that look at the same market segment. There are also ETFs on single stocks, an incredibly stupid idea. Just buy the underlying stock. There are also ETFs on ETFs, again, an incredibly stupid idea. Just buy the underlying ETF. And the reason for that will become apparent in a second. The growth locally has been steady but not as spectacular. We had our first ETF in 2001, and as of 2021, there were apparently 223 ETFs across a variety of asset classes here in Australia. When I ran my custom folder, which I have, which contains ASX ETFs and ETCs, I got a count of about 308 ETFs or ETCs listed on the local market. You might ask as to why issuers go to the trouble of listing ETFs, particularly multiple ETFs on a single point. And their answer is really quite simple. The overwhelming motivation for listing ETFs is to collect fees. And in fact, I'm going to rephrase that sentence. The only motivation for listing an ETF is to collect fees. I want you to keep this in the back of your mind because this is the salient point for this little chat. ETFs are a business. The people who issue them are in the business of issuing ETFs and collecting fees. And to be honest, it is fairly easy money. And I say it's easy money because the vast majority of ETFs are aimed at being what we would loosely term passive. That is, they pick a particular index, particular market segment, and they simply try and replicate the performance of that. So there's no attempt at outperformance. For example, if you have an ETF over the S&P ASX 200, all it simply does is replicate these stocks in that index in the proportions they occur within the index. But it is a business, and it is in the business of collecting fees. And this simple business decision, this business metric, does actually govern an investor or a trader's decision as to what sort of ETF they will actually participate in. In trading, one of the things we're confronted with are first-order decisions. The problem is most people spend their time thinking about second, third, fourth-order decisions. That is, what does the chart of an individual instrument look like? But time and time again, testing and the research will tell you that it is more important to select a market or grouping than it is to select the individuals within that grouping. With markets, that's generally quite easy to do. And there's a few ways we can do it. You can compare markets across a given time period and look at their relative performance. You can even use this to select individual ETFs that you might be interested in. But this is a time-honoured method. You might have something for equities like an RSC comparison. You pick the one which you consider has the greatest relative strength versus an index. Or it might be a more pragmatic metric, such as it must have a turnover greater than X, a figure that you consider acceptable for you to be able to enter and exit that stock relatively frictionlessly. And we come to this notion of the business. So let's go back to thinking of ETFs as a business. If I have a business whereby the costs to run the business are 1 million per annum, I need to make more than 1 million per annum for this to be viable for me. If all the costs I incur running the business, such as rent, staffing, compliance, all the other bits and pieces, is 1 million a year, and I make 1,100,000, I have a business that is profitable. It is not wildly profitable, but it is profitable. So that's our consideration. But consider this with some of the ETFs that are thrown out there as candidates for people to invest in or trade. iBuy, which is a locally listed ETF, has $1 million in assets under management. It has less under management than what it will cost you to buy a reasonable house in a reasonable suburb in Melbourne, Sydney or Brisbane. Compare this to VAS, which has 1.23 billion in assets under management. This notion of assets under management is an important consideration. It is an important consideration because it determines whether an ETF is viable for the issue to continue with. One of the things to note about ETFs, in fact any listed instrument, is they don't exist in perpetuity. Particularly if you're running the business of an ETF, if the ETF does not pay for itself, then there's really no need or motivation for you to keep the ETF on. You can think of it as an underperforming member of staff. You simply cut them. Granted, there is some sort of cross-collateralization of fees if you have multiple ETFs listed, but sooner or later the decision becomes necessary as to which ones you will keep and which ones you will bin. And if we have a quick look at a league table of locally listed ETFs, we can see the enormous disparity between those in the top 10 and those in the bottom 10. And I will give those in the bottom 10 props for the names that they give their ETFs, such as the code TAN represents solar ETFs. I Eat is the future of food ETF. So I will give you points for that. It is creative, but it does not seem to actually really grab anybody's attention. And what you'll see here is the code, the issuer, the name, the assets under management, and the market cap. There does tend to be a relationship between assets under management and market cap, although it's not fixed. And when I have reordered these for market cap, you do get different places in the league table. And you can see this in the bottom 10. If we look at assets under management for most, they're all under $3 million. iBuy has $980,000 under management, which is pitiful and really not sustainable. But there is a quirk or a nuance in this. If we look at USTB, which is the US Treasury bond currency hedged ETF, you can see that the assets under management are only just above $2 million, but the market cap is $684 million. That's a function of the outrageously large number of shares they have on issue. They have about 79 million shares on issue, which is completely over the top for a fund of that size. But what this shows you is the disparity in the market. They are by no means homogeneous in their distribution of either assets under management or their market cap. So this presents a problem for people looking to invest or trade these instruments. And we come back to this notion of a first-order decision, selecting the market you want to be in, because this is a crucial decision in any form of investing. Select the wrong market, and it does not matter how good your selection skills are, how good your management skills are, it will probably still end up as a bust. And you can see immediately the problem that is apparent with these smaller ETFs. The simple issue is that for investors, they're not viable in terms of the turnover that would be involved in them. They would be quite naturally illiquid. And this is simply a function of their size. So we come back to this notion of the business. Remember, the job of an ETF issuer is to collect fees. Some businesses are not worth owning, whereas others very much are worth owning. And so with ETFs, you have to in some way, shape or form set a benchmark or some form of landmark that defines where you will commit your capital to. For example, just as a little experiment, at $250 million under management, approximately only 95 local ETFs qualify. The rest do not. So only a third of all ETFs listed on the ASX qualify for this benchmark. The other 2/3 do not. You might ask the question, why they pick 250 million? Well, let's do some quick mental arithmetic. Running a fund is very expensive. And it's expensive in terms of the compliance and back-end issues that you run into. So let's make the assumption that to run a fund costs me 1% per annum. If my fund only has $100 million, I'm making $1 million a year. My back-end and compliance costs, the cost of running the office, the cost of paying the staff, is probably in excess of $1 million a year. 1% of 250 million is 2.5 million. All of a sudden, the business looks a little bit more viable to me. And remember, we come back to this original point. If an ETF is not viable for the issuer in terms of the fees it generates, then sooner or later it will be delisted. And a quick word about the delisting process. What people assume happens is that the ETF is delisted on a Monday, you get a check on Tuesday. That's true. It's just that that Tuesday might be in a year's time. It is not the seamless process that people think it is. We can apply this metric to the US as well, and intriguingly enough, and this is just one of those coincidences that appear, only 1/3 of US ETFs also pass this benchmark. What is intriguing about looking at the US market is the number of ETFs that are quite literally dogs. You could make the argument that they are simply cynical listings, designed to cash in on the boom in ETFs and in some way, shape or form to generate fees. Because remember, the only motivation for listing an ETF is to collect fees. It has no other benefit. This is not some sort of charitable endeavour where an ETF issuer has gone, look, People really need a vehicle that enables them to invest in a simple manner in the S&P 500. I think we should do that for them because we are decent chaps. The conversation goes more along the lines of, these things are absolutely flying. Every wood duck in the world is buying them. How do we get one? How do we get a slice of that action? Well, that's simple. We'll just list an ETF on an ETF. And someone will put their hand up and go, that's a really stupid idea. Who's going to fall for that? And people will go, yeah, they will, because people are that stupid. ETFs with small market caps and very little under management pose an existential risk to investors and traders. They have a very, very specific risk that applies to them and them alone. Think of it as a business that is running on fumes. Now, I understand that the bulk of stocks on the Australian stock market do not make any money. They will never make a profit, and they will disappear and be consigned to history and be replaced by another one. We're able to do, in some way, shape or form, deal with that because there is generally speculative turnover in those sorts of instruments. If we look at a lot of the lithium stocks from 2 years ago, even today they still have quite substantial liquidity. Same is true of uranium stocks that were the big thing earlier on this year. They still have turnover that enables you to get out. Many ETFs do not have that. There simply is not the liquidity to get out. There is always somebody to buy from because there is always somebody looking to get out. But sooner or later the music will stop and you will be the person who wants to get out. Therefore, not only do you have to set cut-offs in liquidity, you also have to set a cut-off point in terms of assets under management for which you are willing to commit capital to a business. Because you have to constantly be aware of or have in the back of your mind that sooner or later the owner of the business might actually just shut the doors and you will be left standing there wondering what on earth has happened and when on earth you're going to get paid out.